Oh, what's going on, everyone? So, I've recently been changing my strategies a lot. And in this type of market, I think that's pretty important to be flexible. Because if you can't adapt to what's happening, everything's changing so quickly that you're probably going to end up losing out on a lot of money or losing a lot of money. So, I mentioned in a couple other videos that when this whole thing started, I started out buying puts. A general explanation is if you buy a put, and the stock price goes down, your put option price will go up. So if you are feeling the stock price goes down, you buy a put, the stock price goes down and you make money. And that worked for a little while. But the premium started to get so high that if you bought a put and the stock price moved down a lot, you still might not make money just because you paid so much for that option. And then what I started doing is either buying very deep in the money puts, which had a little bit more protection as far as the premium went, but you could lose out a whole lot more money because you were actually paying more up front. And I was buying regular stock assuming it was going to go up, whether that be for medical companies, PPE, or similar stocks. Once everything started stabilizing, I changed strategies again. I started buying stock and selling covered calls, which is still one of my favorite strategies just because you're collecting premium. It's relatively safe assuming that the stock itself doesn't tank overnight. And I was buying and selling vertical spreads. My favorite is selling a vertical spread, which you'd call a credit spread because you're taking in a credit. When you buy a vertical spread, it's a debit spread because you are paying a debit. On these, I would usually, like against Tesla, what I did is I would sell a credit put spread. If the price went down, I would lose money, but if Tesla went up, I would keep the premium that I collected. And I did a few of those while also buying, which would be a debit call spread. So when the Tesla price increased, I would gain money that way. I still owned a few outright puts and calls on different companies. Like Boeing, I had a strangle where I had bought a out of the money call and a out of the money put. And on that, I've been selling calendar spreads and diagonal spreads. So where my puts expire in, I believe, June or July, I've been selling weekly calls and puts against those, taking in premium, and that offsets the cost of my degrading premium, where I will probably profit overall once those completely expire. And I've done a few iron condors, which is where you do a vertical spread on both sides of the stock. I had messed around with a few of those on the SPY. In this type of market where volatility is still crazy, I'm preferring just staying on one side with a regular vertical spread instead of the iron condor. There's a few more complex strategies I'm looking at, but for the most part, I'm trying to keep everything very simple and easy to manage. This video was a little shorter than I thought it would be. Either my strategies are really simple or I probably didn't go into enough detail. Comment down below on what you'd like to see more of or if I'm missing any information that you wanted to know. But thanks for watching, like, subscribe, and we'll see you next week. Okay, Tesla, what are you doing?